If you think McDonald's makes its money from burgers, you're missing the real play. The menu is just the front. The real engine is underneath. While customers focus on meals, the company is focused on ownership, land, locations, and long-term control. That's why nearly all their stores are run by franchisees, while McDonald's sits back collecting rent and fees with precision. So when you see those numbers climbing, it's not just about food sales. It's about a system designed to win quietly, consistently, and at scale. To really understand how McDonald's prints money, you have to shift your focus away from the food and look at what's under it. The real story isn't burgers or fries, it's land. Most franchises sell you a system and let you figure out the rest. McDonald's does the opposite. They control the ground, the structure, and the long-term value of both. When someone opens a location, they're not just running a restaurant, they're stepping into a property arrangement where McDonald's sits firmly in the landlord position. That changes everything. Because while operators are dealing with rising costs, ingredients, staff, power, McDonald's is collecting rent. And not just any rent, it's structured in a way that scales with success. There's a base payment, sure, but layered on top is a percentage of revenue. So when prices rise and sales numbers inflate, McDonald's earnings quietly climb alongside them. No extra effort, no added risk. It's a setup where the operator absorbs the day-to-day volatility, while McDonald's benefits from the long-term stability of real estate and the upside of growing sales. That's a rare combination. Most businesses have to choose between control and scalability. McDonald's engineered both into the same model, and that's why their margins sit in a range most restaurants can't even get close to. They're not just selling food. They've positioned themselves at the intersection of real estate and retail, where every transaction flows upward. Once you see it that way, it's hard to unsee. There's a newer layer to the McDonald's money engine that most people still overlook. It's no longer just about location and rent, it's about information. Quietly, the company has built one of the most valuable digital ecosystems in retail. By early 2026, their loyalty program had pulled in nearly 210 million active users. That's not just a big number, it's leverage, because every one of those users represents a direct line of communication. No middleman, no guesswork. Think about how that changes the game. Before, they had to spend heavily on ads and hope you showed up. Now, they can reach you instantly. A simple notification timed around your habits does what millions in advertising used to do. And is not random, it's precise. They know what you like, when you usually order, and how often you come back. That level of insight reshapes customer acquisition entirely. The cost drops, but the effectiveness climbs. And then there's behavior. In the US, something interesting happened. Once customers joined the app, their visit frequency didn't just increase more than doubled, from around 10 visits a year to 26. That's not a small bump. That's a shift in routine. But it goes deeper than marketing. Every order placed through the app is one less interaction that needs a cashier. Over time, that chips away at labor costs while keeping the experience fast and consistent. You're not just buying food, you're participating in a system that's been designed to run leaner with every tap. This is where the real shift happens. The margins aren't just protected by real estate anymore, they're amplified by data. In this version of the business, information isn't a side asset, it's the core advantage. While a lot of companies are slowing down under the weight of high interest rates, McDonald's is moving in the opposite direction. They're expanding fast. Not recklessly, but with a very specific objective in mind. They're pushing toward 50,000 locations, the largest footprint they've ever had. But this isn't just about growth for growth's sake. It's about reinforcing a reputation that matters a lot in the investment world. Consistency. Hitting the 50-year mark of increasing dividends isn't just symbolic. It puts them in a rare category. Very few companies can promise that kind of reliability, especially across different economic cycles. And that's exactly what attracts serious capital. Because when large funds decide where to park billions, they're not chasing hype. They're looking for stability that still produces returns. McDonald's offers both. Even when the broader market gets uncertain, their structure keeps cash flowing. And that's where their strategy tightens. They generate massive free cash flow billions every year, and they don't just sit on it. A big portion goes back to investors through dividends. Another portion is used to buy back their own shares. That move quietly increases the value of remaining shares while keeping the stock price supported. It's controlled, deliberate, and highly effective. So while the outside world sees new locations popping up, the real story is happening underneath. Expansion feeds revenue, revenue feeds cash flow, and cash flow feeds investor confidence. It's a loop that keeps reinforcing itself. That's how they hold their position, not just as a fast food giant, but as a financial machine built to endure. The final piece of the 2026 puzzle sits at the intersection of food and technology, and it's their partnership with Google Cloud. McDonald's isn't just upgrading systems, they're rewiring how each location operates. Across tens of thousands of restaurants, they're rolling out edge computing, bringing processing power directly into the store instead of relying on distant servers. That shift matters because speed is everything in their world. Now layer AI on top of that. Drive-thrus are becoming voice-driven. Kitchens are getting smarter with systems that track orders, check accuracy, and reduce mistakes before the food even reaches the customer. It's not about replacing people for the sake of, it's about tightening every second in the process. Because time, for McDonald's, is money in its purest form. Every delay at the drive-thru is a lost opportunity. Every mistake is friction, and friction is expensive. By smoothing out those interactions, making ordering faster, more consistent, and less dependent on human variability, they increase the number of cars that pass through a single location in a day. And that loops right back to their core model. More cars mean more transactions. More transactions mean higher sales. And because their rent structure scales with revenue, that same piece of land starts generating more income without expanding physically. What's interesting is how this reframes the business. On the surface, it still looks like a fast food chain, but underneath, it's operating more like a high-efficiency system, part real estate, part data engine, part logistics network. At that point, the burger almost feels like the entry point, not the product. The real lesson of McDonald's in 2026 isn't about the menu. It's about asset control. By owning the land, they created a real estate moat. By owning the app, they created a data moat. And by owning the supply chain, they created a cost moat. The world might change, and people's tastes might shift, but McDonald's has positioned itself to win regardless. They don't care if the price of lettuce goes up or if a specific store has a bad month. They own the dirt, they own the app, and they own the royalties. Next time you see those golden arches, don't see a burger joint. See a $230 billion financial fortress that just happens to have a kitchen in the back. Because in the game of global finance, the person who collects the rent always wins.